Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Today's interview is a terrific insight into Aussie oil and gas giant Woodside Energy. This week, Woodside reported an underlying profit of $4.5 billion for the 12 months to the end of 2024, hit by lower oil and gas prices. This interview with CEO Meg O'Neill looks to the future of its massive LNG project in Louisiana and the impact the Trump administration is having not just on Woodside but the whole energy sector. This reporting season, we're partnering with the team at AusBiz to bring you interviews with some of Australia's top business leaders. AusBiz is the country's leading provider of live and on-demand video of the latest news in Australian business, markets, economy and startups. Sign up for free at ausbiz.com.au. Meg O'Neill, CEO of Woodside Energy, spoke with Nadine Blaney and started by answering the question of what provided the confidence to pay out a better than expected dividend.
Look, a couple of things. The result really reflects the strength of the underlying business. We have a really strong, outstanding base business. Our LNG assets in Australia were performing at a very high level. We started up a new project offshore Senegal that has performed extremely well. When you look at the numbers, earnings before income tax and depreciation of over $9 billion US dollars. That translates to a net profit after tax of $3.6 billion US dollars. That gives us confidence that we've got a strong base business that allows us to pay out at the upper end of our payout range. 80% dividend to shareholders, fully franked. So for our Australian retail shareholders, at the end of the day, it comes down to about $2.68 inclusive of the franking credit benefit. Really a phenomenal result.
There was some concern that Woodside is under-provisioned for future restoration spend after a 2025 miss. So there's also the potential, I suppose, for tougher future regulation when it comes to restoration. So you don't feel that you're sailing too close to the wind when it comes to, the potential restoration risks in the future? No,
we're very rigorous in our process for estimating restoration costs. I mean, it's a critical element of our financial statements, and we've got an obligation to ensure that that's fairly and transparently reflected in the statements. We have indicated to the market that 2025 is going to be a big year for restoration activities, largely as we deal with some legacy assets. So there's a number of fields that haven't produced oil or gas for 5+ years, and we're cleaning those up. So we do have a big spend this year. Next year it'll drop down again. And 27 is going to be another big year as we remove platforms in the Bass Strait. But this is a normal part of the business. The spend is not going to be flat every single year. We will have ups and downs based on activity. But again, we're doing the right thing. We're tackling the decommissioning obligations that we have and making sure that we return the locations to the condition in which they started.
This is a big question, but what's the status of the equity sell down in Louisiana?
It's going very well. So our objective is to retain about 50% of equity in the opportunity. We want to put together a dream team of investors. And one of the things that was really attractive to us about the opportunity when we started looking at it was the opportunity to get 100%, get control of the site. We've got the permits we need. We have the contractor we want. So in many ways, it's already an advantaged project. But with us having 100%, we can bring in the partners we want. And we're in very detailed discussions with a number of potential Dream Team members about coming into the project.
So is that a 50% stake that you're looking to offload?
Correct.
Yeah. And so what would you need to happen before you would greenlight that final investment decision? And when do you expect to do so?
Yeah, we want to be ready to take the decision in this quarter, but we will take the decision when we've either got a signed and sealed agreement from potential partners or we have high confidence that we're going to get there. But the team's working very hard. The team would really love to land those commercial agreements and bring the partners in by the first quarter so that we can take that decision at pace.
Time is ticking. Have the discussions or the nature of the discussions with potential Dream Team partners changed in the wake of the new administration?
Look, I think it's probably been a little helpful in terms of providing an opportunity for investors to get into the U.S. oil and gas sector. Now, a number of the folks that we're talking to are U.S. players. They're interested in getting their molecules exposed to international markets. The international players we're talking to see this as an opportunity to signal their country's support for things like adjusting the balance of trade. It's very clear with the new U.S. administration that he's very concerned about trade deficits. And one way for a nation to quickly adjust a trade deficit is to buy more energy from the U.S. So we are seeing a bit of pull from some of our prospective partners and from prospective LNG buyers. That's probably been sparked by the new administration.
So is the new administration, a Donald Trump presidency, a boon for Woodside and your investors?
Look, the interesting thing about the U.S. is the free markets work very effectively in the U.S. Oil and gas production grew under Trump in his first administration. It grew more under Biden. Solar and wind renewables investment grew under Trump. It grew under Biden. It's continuing to grow. So the free markets work very well in the U.S. What I think Trump does is with his statements like drill, baby, drill, he makes it really clear that affordable energy is important to the American consumer and the American economy. So that really strong support for the oil and gas industry, that direct messaging, I do take as a positive for us that it's a place where our industry is well supported.
Any concern around tariffs? I'm thinking aluminum, and that could be for the potential U.S. operations in Louisiana or here in Australia?
Not particularly. Look, when we look at our business, when we look at where we spend money, where we look at we have trade, we don't feel like we've got a lot of exposure to tariffs at this point in time. For Louisiana LNG, which is a project where we would be in a heavy construction phase, we have a free trade zone at our plant site. So again, we would be able to import materials to that site free from tariffs. So we've got a lot of confidence that we'll be able to deliver the project at the indicated price, even with potential tariffs.
So let's talk politics here in Australia. And you've been vocal already about the delayed approval for the Northwest Shelf extension. But the reality is we've got a federal election looming here. How do you think that the energy policy debate will unfold over the coming months?
Australia has been really fascinating because climate change and energy policy has been at the heart of federal elections for 20 plus years here. I think what we're seeing from the major parties is a greater recognition that gas needs to be part of the mix. The coalition's been very supportive for many years. With Labor, the Future Gas Strategy that was released last year affirmed gas needs to be part of Australia's energy mix to 2050 and beyond. And Australian gas has a role to play in helping decarbonize our region to 2050 and beyond. So we've got that headline level of support. As you start drilling down to Northwest Shelf, this is an asset that has provided domestic gas to businesses, manufacturers, and households in Western Australia for more than 40 years. Our current approval expires in early 2030. If we don't get an extension, that's going to affect jobs in 2030. It's going to affect our domestic gas customers in 2030. It's going to affect every household in the state who are going to see the risk of uncertain power supply. And at the end of the day, from an environmental perspective, the outcome will be our coal-fired power stations will stay online longer. So it's a bad outcome from an environmental perspective. So I really don't understand why anybody is opposing this. It's good for the economy, it's good for jobs, it's good for the environment.
Okay, so that's the worst case scenario if the Northwest Shelf extension and the debate around it continues in a negative light. The good news is that we'll have potentially, domestic gas supply and everything else. I know nobody has a crystal ball when it comes to pricing, but you've reaffirmed your production guidance. And when it comes to pricing, what can investors sort of expect? Because at the end of the day, oftentimes, it's the production, it's the sales volumes, and it's the price you're achieving for it.
Yeah, absolutely right. We produce a commodity. We sell into the open markets. We don't set the price. The things that we can do, though, is make sure that we're running a highly reliable and cost-efficient business. So if you look at some of the numbers we reported, our LNG plants, 98% reliability, that's world-class by any measure. Our unit production cost of $8.10 a barrel of oil equivalent was down in 2024 versus 2023. So we're very much focused on controlling the things we can control, maintaining high margins in our business. Our earnings margin is industry leading. So we feel like we've got a very strong base business. We're well positioned. We sell our products on a variety of commodity indices. So we sell some of our production with price links to Brent, which is the oil marker. We sell some in the gas spot market. We do have a bit of domestic gas production in Australia that's, I would describe it as fixed price or almost fixed price. So those are the sorts of things that we do to ensure that we pay the bills. We do a little bit of hedging as well, again, just to make sure that we've got enough revenue certainty in the year to cover our base operating expenses. When we look at the conditions of the market, look at the crystal ball gets pretty muddy. There's a lot of different factors at play. We look at the health of the Chinese economy, which is probably a little bit soft. But you look at things like sanctions. Again, Russian crude is still in the market, but Europe's talking about tougher sanctions. The US is talking about tougher sanctions on Iran. So there's a lot of variables that make it very difficult to predict pricing. Again, and that takes us back to we focus on the things that we can control and the value we can deliver for our shareholders.
Wonderful. And so, once the Grand Tour's, coming to an end around this set of results, so it's that final investment decision in this first quarter that's really looming large.
Yes, that's the nearest upcoming decision, very much focused on sell down, getting the right partners in, making sure that we're ready to take that decision, from as early as the end of the first quarter.
That was Meg O'Neill, CEO of Woodside Energy, talking to Nadine Blaney on AusBiz, Australia's leading provider of live and on-demand video of the latest news in Australian business, markets, economy and startups. Sign up at ausbiz.com.au. It's free. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.